Macquarie Group CFO Alex Harvey steps down. What you need to know. Imagine waking up to news that a 29-year veteran CFO of a financial giant is quitting, without warning, just as they were in the running to lead the company. That's exactly what's happening at Macquarie Group, and here's why it matters. Alex Harvey, 54, is stepping down as CFO of Macquarie Group Limited after an 8-year tenure, despite being tipped as a potential future CEO. His departure, effective December's end, with full retirement in 2024, comes amid regulatory probes dogging the Australian firm, though the company remains mum on why he's leaving. Harvey's exit isn't just surprising because of his longevity, it's also a blow to stability. As CFO, he oversaw financial strategy during turbulent times, including navigating stricter oversight. His replacement, Deputy CFO Frank Kwok, faces a steep learning curve. But here's where it gets controversial. Harvey's departure fuels rumors of internal power struggles or dissatisfaction with the company's direction. Is his exit a red flag for investors? Critics argue his silence on reasons for leaving raises questions about governance transparency. Others defend the move as a natural succession step. Macquarie, a $64 billion investment bank, is no stranger to scrutiny. Recent regulatory investigations into its practices have pressured leadership. Was Harvey's role in managing these challenges a factor? The company denies any link, but skeptics aren't convinced. And this is the part most people miss. CFO transitions at this level rarely happen abruptly unless something's amiss. Harvey's departure leaves a vacuum, especially with Kwok lacking Harvey's CEO-level experience. So, what's really going on? Is a calculated move to refresh leadership or a symptom of deeper turmoil? We want to hear from you. Do sudden C-suite exits like this erode trust in corporate leadership? Share your thoughts. Macquarie faces shareholder revolt over $30 million CEO pay, an ASIC lawsuit, executive pay crisis. Facing a storm of controversy over its executive pay practices, Macquarie Group has announced a comprehensive review of its compensation policies. This move comes in response to a shareholder revolt and a recent regulatory lawsuit that has shaken the company's stability. But here's where it gets controversial. Some argue that the high salaries are justified given the performance of the company, while others believe they are excessive and out of line with industry standards. The CFO, Alex Harvey, is stepping down unexpectedly, leaving the company without a potential successor to CEO Shimaro Wickramanayake, who took the helm in 2018. Shares dropped sharply in early trading, falling 5% to $214, marking the biggest single-day percentage decline in 3 months. This underperformance contrasts starkly with a modest 0.2% gain in the broader market index. Chairman Glenn Stevens addressed the media, acknowledging that the upcoming non-binding remuneration vote at the AGM appears to be closely contested. When pressed on potential shareholder dissent, Stevens expressed disappointment, but acknowledged the reality of the situation. "It's disheartening to say so many people take issue with our approach, but we must listen to their concerns and act accordingly," he stated. A defeat of the vote requires 25% opposition, and if an Australian company receives 2 consecutive strikes, shareholders can initiate a vote to oust the entire board. This dramatic turn of events coincides with the Australian Securities and Investments Commission, ASIC, suing Macquarie, alleging misreporting of up to $1.5 billion in short sales over a 15-year period. This misrepresentation, according to ASIC, misled the market and violated post-financial crisis transparency regulations. In response, Stevens emphasized Macquarie's commitment to addressing regulatory issues and enhancing its risk culture. Wherever we fall short, the board ensures accountability, encourages future improvements, and reflects on what these issues reveal about our organizational culture, he assured. Shimaro Wickramanayake, Macquarie CEO, received a staggering $30 million in 2024, making her the highest-paid CEO among ASX 100 companies and the sole woman in Australia's top 20 highest-paid executives, as per the Australian Council of Superannuation Investors. This statistic has fueled the debate over gender pay gaps and executive compensation in the corporate sector. Macquarie also reported a dip in first-quarter net profit, attributed to reduced contributions from its asset management division and the commodities and global markets unit. The company refrained from disclosing specific profit figures in its quarterly trading update. The asset management arm suffered mainly due to the timing of investment-related income, while commodities saw lower net interest and trading income, particularly in North American gas and power. Macquarie's 1Q profit drop. Asset management and commodities struggle. Profit slumps at one corporate titan, while another surprises with soaring sales. Yet neither tale is as straightforward as it first appears. Ready to unpack the details? First, the headline shocker. Australian financial powerhouse Macquarie Group watched its profit for the first quarter retreat, largely because revenue from its asset management arm and its commodities division lost momentum. Investors who viewed Macquarie's diverse lines of business as an ironclad shield against market swings may now be second-guessing that assumption. But here's where it gets controversial. Was this downturn simply a temporary lull in volatile commodity prices? Or does it hint at deeper structural challenges inside Macquarie's celebrated annuity-style businesses? Some analysts argue the group's heavy reliance on performance fees and trading income makes its earnings more cyclical than the company lets on. Others insist the dip is a blip and point to Macquarie's long record of bouncing back. Now switch gears to Silicon Valley. Unity Software, the engine behind countless mobile games and 3D experiences, closed out the year with a genuine curveball. In the fourth quarter, Unity's revenue surged 35% year-over-year to USD $609 million, handily beating Wall Street's consensus estimate of roughly $1,563 million. If you're new to earnings season lingo, beating the street typically sparks investor enthusiasm because it means the company outperformed the analysts' pooled forecasts. Still, Unity posted a net loss of 66 cents per share, reminding us that growth alone does not guarantee profitability. And this is the part most people miss. High-growth tech firms often reinvest aggressively in research, acquisitions, and marketing, sacrificing current profits for future dominance. The question becomes, how long will shareholders tolerate red ink in exchange for breakneck expansion? Quick transparency note. The information above is offered strictly for educational purposes and should never be mistaken for personalized investment advice. We strive for accuracy but cannot promise perfection, so always do your own due diligence. Bold talking point. Some commentators claim Unity's widening losses prove its business model is unsustainable, while others argue the firm is laying the foundation for industry-leading margins once its ecosystem matures. Who's right? Your turn. Do you view Macquarie's profit dip as a fleeting headwind or a warning sign? And when it comes to Unity, would you prioritize revenue growth or insist on a clear path to profitability? Jump into the debate and let us know where you stand.